wholesale inflation that rose only 0.5% in September, but still slightly more than expected. Right now, we're looking at situations that if Iran enters the Middle East war between Israeli and Hamas, Palestinian, we're going to see an oil price surge. So it depends as it spread out a bit more. So if we take a quick look at that news right away, just tell me, oh, let's take a look at the oil. Anyway, but it's just at that level, at that elevated level, because volatility in the Middle East situation, but we're still staying below $85 right now. So again, until confirmation or very likelihood of some event that will take place that changes the fundamentals of the particular instrument or the underlying sector, individual companies, that won't materialize yet. So that is something in the back of my mind, just put it on the back burner. So let's go right into it. Since we try to look at the wicks, VIX is coming back off, 200 days moving average below that, so the market just like up, flat to up in that sense. Dow Jones is right at 200 days moving average, so that's some important psychological level basically. You know, your S&P 500 coming back to where the gap is, we're coming back to the previous breakdown, the low previous breakdown right here. So we'll see how it's going forward. We'll try to go up. Here's the thing. The thing is, after a nice run for the first quarter of this year, it went into more of a sideways consolidation mode for the summer. It created kind of like a double bottom, triple bottom situation. And now it's trying to run up again. The resistance line is actually this. In a sense, it's this. It has to break above this resistance line, the orange line, for it to go back into a bull mode. And then the next one is the previous peak. That's actually two levels for it to comes back and continue uptrend. Or you can break this level and turn into a downtrend in that sense. Right. If you ask me, I think we have more probability of making it an up run than breaking down, unless, of course, fundamentals, economic data, the macro environment, and individual earnings that coming in tells us otherwise in that sense. As on back of a nice run of this year. However, until the market says so, until I see technical confirmations, that won't trigger any trade in that sense. So, but we're right at the point where the possibility of a continuation of an uptrend from that is higher than anything else right now. But don't think about, oh, look right here, Google we have it marked. All right, been watching it. We see a MACD divergence, it coming off, but out of the Magnificent 7 stocks, the Google is the one that is looking like it's going to break up. It wants to continue its uptrend. Well, actually, it didn't really make an uptrend, remember. Okay, what it did was more of a, this year, of an up, sideways, a ladder situation on that. But if you pull it out to say a monthly, yeah, that definitely uptrend. Right? As you go back into the more details, compress the time frame into a weekly, you still have a nice uptrend. Right? But it's the daily that you see the ladder up, sideways, and then another up. Right now, is it going to break? I think very likely. The question, do I trigger my trade when it breaks? Because of the macro environment, as compared to the NASDAQ, the indexes, is not breaking its peak, I can wait for it to break and make a pullback. So there's two levels of trade. The first is, do I open the trade when it breaks, which is any day now. Right? Today might break it, and tomorrow it will make a new high of today's high. That is a setup for breakout trade. That is set up for the first initiating the position. That's the first question, is do I initiate that? In this environment, in this macro environment, right, that you have the Middle East volatility situation, yes, it doesn't directly spill over to the US economy, right, but you still have pressure there in the macro environment. On top of that, the interest rate environment, inflation, all of that, right, give us some level of uncertainties that is not aligning with the bold statement. So you have a couple of things that is kind of neutral, right? While the stock itself want to break up, while the index itself maybe it want to break up, but it came off a high, and next level is you need to break this high also. So this is the picture. This is the picture to envision, is that when Google breaks up, this means NASDAQ will break up too. When it's going to stop? When it hit the next level, which is the peak, previous peak, and you will see Google, that's where its hesitation comes in when it breaks up. And then I would likely see a pullback on both the NASDAQ and the Google stocks. That pullback will test the result of this continuation of the uptrend and see if buyer comes in, and now should look for false signal. Now, if I see buyer comes in, indication of that, that will be the trade to take in actuality. That's where you initiate that trade because of this environment, because of the NASDAQ, because of the macro, because of the economic situation. So you add all these variables together, multi-factor models, right? And you can see and determine where you start opening the position. Yes, the breakout, but if it's the other way around, the macro picture is clean, it's very positive, economically positive. Fed is saying, okay, inflation is in check, everything is good, then I will take the breakout trade instead of a pullback after the breakout. Make sense? Have to be patient. That's the big part of this game, especially when you're trend following, especially when you try to make these ladder trade that you're going to keep leveling up, right? Keep adding to a winning position. You want everything to align, but then here's the thing. When everything's aligned, it's always too late. There's always element of uncertainty inside any trade, and the question becomes, what percentage of uncertainties, what factors that you will weight more, or factors you will weight less on this multi-factor model, right? All that comes down to, when do you open the trade? When do you initiate trade? And that is the explanation. On Google. Google want to break up. The market want to break up. Macro environment is more or less neutral or even slightly negative. Right? The global politics, global situation is not everything. Not everybody's partying, right? The Ukraine situation is going on. You have a new flashpoint in the Middle East. Right? That doesn't directly spill over to U.S. economy. However, it does affect the world economy. Right? China is not doing too well either, right? But if everything is Middle East situation resolved, or at least they ceasefire, like Ukraine is coming to close, they start talking, and then China is picking up the GDP and the economy is turning around. Hey, everything's rosy. Hey, if it's a breakout, I will buy the breakout and I expect a momentum move. I won't wait for a pullback on that. Right? So these are little details that you have to keep in the back of your mind. You have to follow. You cannot just say, I would just take a trade on the chart alone or on the fundamentals alone. All that have to combine. All have to come back together. Right? Matter of fact, as we're watching, we can see the fundamentals of Google. Right? I'll go to this site called Macro Trend, and it gives me a really quick layout of charts of all the fundamental data that I want to see. Why is it not loading? Okay. Did I type the wrong macro? Trend. Okay, let's Google do the same. Trends. Okay, see? Thanks to Google. Hey. Okay, so alright, so let's look at Google. And which one do I want to look at? Revenue? Net income? Gross profit? All of them. The answer is all of them. Right. So let's do a quick look. Let's look at the financials. I just go inside. Now we're inside Google Alphabet. Right here, I can see the charts. Wow. Last 10 years doing well, right? Revenue, right? Gross profit, wow, doing well. So it makes sense for it to trend up. Although this is a very big picture. This is only yearly data, not just this year, but we can see all the data, all the fundamentals align. Yes, it's not as good as last year. That we can go inside detail and find out why it's not as good on some of the other numbers. But if you look at net incomes, right, that's a good 15% off from last year, right? But this is 21, 22, not even 23. Right. Okay, so let's look at cash flow. Cash came, right? Discounts cash model, DCF. That's majority of the fundamental funds use. Warren Buffett, huge fan. That's what he really do. He doesn't look at macro. He doesn't, because he's a super long-term investor. But he has to look at undervalued company that is undervalued, right? Then you got to go back to DCF. You got to go to discount cash flow. Right? You do your valuation based upon those principle and theories. Right? So I don't have this year's data. But I can see overall cash flow from operating activity. Hey, it's doing pretty well overall this year. So it makes sense for people who want to buy this stock, want to hold the stock, keep it up. So every time there's seller, there's buyers coming in. Because hey, you sell it, I will pick it up. You sell it even lower, Warren will come in and want to buy these. Right? People like Warren Buffett, they look at the valuation model, they will come in and buy these. So that gives you conviction to stay with a trend. Coming back. So let's start going through the daily list. Alright, so I'm looking at the histogram, the MACD, moving average, convergence divergence. I'm seeing crossover. It's still on the negative territory. It's turned green on the histogram, so that is start picking up. Right. So when it breaks this resistance line, it will cross over the midline, and you will see much more green bars continuation of that. And then on the Heikin-Ashi chart, right, it already showing that, it already breaking up. Oh, that's Alphabet. Let's go back to there we go. Yes, now that makes sense. Right? And again, we can still draw the same resistance line. And when this break, Google is going to break at the same time. They will break at the same time. Yeah. And then the next resistance is this top. Secondary resistance is this top. If you break this top, then the market has a huge bull mode, basically. Yeah. We have a couple months till the end of the year, last quarter. So the question is it going to make a run? It looks like it's picking up. Looks like it's attempting. And we will see and wait for visual confirmations. That's the technical analysis part. Is you can make projection, but you wait for visual confirmation. While fundamentals, you make projection. And then you place a bet before the next batch of number rolls out. This is why fundamental play, it takes 6 to 18 months to develop. On the long side, the short side is much shorter. 3 months to a year, your short should be working out if your fundamental analysis is correct. For the long side, it will take 6 to 18 months to materialize on your valuation, on your projections. Hey, Meta's right there too. Double top. Meta will want to break up. It's looking that. Is there some news fresh today? Let's see. Metaphors faces probe manipulating content. Okay, yes. Yeah. So yeah, nothing major fundamentally that will affect this underlying fundamental variation. We have Meta, it's going for that. Now we have Tesla. Everything is just coming off the low, is picking again, except Netflix, FX. So this is the week. This is not the one that I would not buy of all these, even the market start turning bull. If I'm really bullish and start initiating my positions, Amazon is still staying low, so that's the one you avoid. Microsoft's coming back up. I double bottom on that. Now there's Heikin-Ashi. Heikin-Ashi is much more useful for seeing a continuation of trend, seeing a trend indicator. If we go back to your candlestick, all right, let's go back to our candlestick. All right, let's go back. If we look at Apple, Google broke up, but less hesitation bar yesterday. A doji style. You see this? So on the breakout along, that does not initiate a trade because that's hesitation. MK divergence. Your MACD is still. Your MACD actually this one turned positive way before. See, way before the breakout, it turned positive. The crossover happened way before. This is interesting because typically, moving average a lagging indicator. Very lagging indicator. At least a field bar. It's great to exit a trade because it will lag. So the turnaround kind of already happened for a few bars. That's when you want to get out, right? You don't want to get out on a turnaround right there because that's a lot of fake indications. So it worked perfectly as a lagging indicator to get out of a trade, to take profit, or when you hit the stop loss. You don't want to get whipped out on volatility, the ranges of daily movements. However, as an entry signal, it lags typically. This time, it doesn't. So that's rather interesting. So the breakout is there. The MACD has given me divergent signals, while the histogram and the crossover took place already. Right? Conflicting signals. So these are divergent signals. This divergence already taken place. Right? Now, the most recent signal is more important. So you have to put a weight to the different variables, different factors. And the histogram, anchor crossover, is more recent, more important than signals that are further back in the past, the divergence. But it doesn't supersede, completely overcome. So I have a slight bow right now on combine these two signals on top of the candlestick pattern. However, I have a doji start yesterday. Right? So that put it in a negative dampening on these signals. Right, so I'm just reading out loud to tell you that what is my mind thinking on all these factors. And again, the question: do I initiate a trade? Do I open the trade? That's at the end of the day is do I open this trade? And the answer again is no, not yet. One, either I see a momentum bar and volume spike. That give me more conviction. Two is if this comes back down, right, I see a long tail upside down false hammer. That means that's end of a trend. That means signal that fund should not open this trade. So today, what is going to take place? It will give me a good indication what the players thinking, what the players doing. Do people want to get off after a nice up run? Or do they want to continue to buy it up? So this is why it's so important to learn how to read the market. Without that, you have no clue. No clue where the buyers are, no clue where the sellers are. What are they thinking? So yes, you have to be patient. Wait for the signal. Meta's breaking out too. 1, 2, 3, 4. Right there, right at this level. Same thing. Google, Meta. They're both thinking the same thing. Meta has a bunch of nice false hammer. Look at these long tail. And then break this level. Now it's the next level. Do a clean break. Initiate the position. Pull back. Initiate the position. Yeah. And stop loss is right here, below this. That's what's the picture I have in my mind. You have to visualize this. You have to able to see all that. Yeah. Okay. Oh gosh, look at that. Yeah, I was talking and did not switch to the graph. But again, that's Meta. As I was talking about Meta. You have these three false hammer, and it's looking for a breakout. Just like Google. Google did not display really a false hammers candlestick, except this right here. However, it's breaking. It broke. It broke up already. So let's compress right inside into the 5 minutes. 5 minutes is the lowest scale I will use since I'm trading daily. Right? But if I'm intraday, I will use 1 minute. 1 minute, you have a lot of noise, a problem with that. Even 5 minutes, a lot of noise. The longer the time frame, the less noise there is, the better to tell. You see, okay, going inside the 5 minute, market open, momentum spike up, but, right, and then second bar, booked up, right there. Okay. Alright, so let's switch also the high candle to 5 minutes, so I can see, because I have my volume. I do I have substantial volume? I have pretty good decent volume on the first bar. Second bar, half two third of that. The volume start coming back, dying down. Alright, so there is some volume there, but it's not a huge volume spike like these, right? Like these over here. It is volume spike. Working the overnight orders for the first 5-10 minutes, and then now it's coming down. Not coming down, it comes down right now on the 5 minutes. So back to the regular candlestick. Look, another attempt. Now it's going to try a second move. Right. Up, sideways up. That's great. Up, come back sideways. Right. Up, come back, see a lot of tails, false hammer, then open your position. That's how it works. Okay, that's how it works. Right now, but another thing is wait till the bar finish. Don't say, okay, right now it's breaking up, I'm going to buy. No, you have to wait till the bar finish because you're playing that time frame, so you have to wait for it to complete. Then you see the actual. Yes, it might run, it might huge run, and then you say, oh, I missed it. But that's the thing, it might come back down and it might hugely drop too. You just don't know, so you must wait for the bar to complete. Then you use that information to determine what you're going to do. Are you going to start the trade, open the trade? It's hugging a 200-day moving average, not 200-day, 200 bars moving average right now. So on top of that, if you go back, okay, you see this? As long as it hugged this, it's good. It broke again. It broke up again. Google just want to run. Is the market running? Right away? Is the market running? No. The market is not running. Here's the thing. You have a divergent signals again. The polar market is just holding steady, going sideways. Wow. Google itself. So this is a strong stock. It's up 1.72%, while the market is only up what? 0.5%. You always buy the strong. So if I'm trading intraday, I will wait for this bar to complete. And the next high, that's a breakout. Or wait for it to pull back to around this level. The final stop hours will be when it go below the 200 days moving average. Or you say, okay, 1 bar close below moving laser edge. That's my exit. Entrance, your breakout, first entrance. Second, your pullback. Here's the thing, if the market starts ripping up, this guy's going to just go to the moon. That's how it works. But I'm not trading intraday. I just want to explain the tactics, the setup remains the same. You can apply to different time frame. So let's pull out to the 15 minutes. 15 minutes definitely, right? You can see all these nice. 15 minutes hugging the 50 bar moving average, the blue line. Right. As you pull out, you will see these. Right. Oh, the next one is 1 hour. 1 hour is hugging nicely to 21 bars moving average. You can see this. You can work clearly on each level, on each different time frame, where other important levels are. You need to be able to see these on different time frame, and you can project better, much better. Right now it's on an up move. Right now it's going to rip up. Of course, since I don't have a position, I'm like, oh my god, I'm missing this trade. No, I'm not missing the trade because I'm going for the daily, a long-term trend falling. So I'm not missing anything. It's just doing its thing. I'm waiting for my signal. I'm waiting for a signal. Yeah, if I trade short time frame 5 minutes, yes, I will have a position. But not on the hourly. If I trade hourly, I do not have a position yet. I still have to wait for the bar to complete, remember? Yeah. So that's that. Google's breaking up, but I'm waiting for it to break up. So it's saying I want to see pullback. I want to see buyers come back in after the pullback. And that will take a few bars to complete. And that, I can open a position. On that, I can very safely open my low delta trade on options. And also, the outright buy the stock. On both open the option and buy the stock. So that's the plan. That's the game plan. And you have to be patient and wait for it to develop. Meta is not really doing its break yet. So Google and then Meta, those are two prime candidates. Tesla's not doing anything. Apple's not doing anything. It's just following the market. Alright. Well, these are the market leader, especially Google. Google is the market leader today. Now, this doesn't stay forever. It could change. Tomorrow might be a whole different pictures. Alright. But today, the play is Google. In actuality. Matter of fact, if I want to play intraday, so I switch back to the lower time frame. And then, since it broke, I didn't buy the breakout, I'll wait. I'll wait for a pullback to the levels, the breakout level, see if it bounces off the breakout level. Right. And initiate intraday trade. But again, I don't trade intraday. But I want to show you what the line of thought and the principle, the setup, everything apply across the board. Doesn't matter your time frame. You even use yearly, monthly, same thing. It's the same principle across the board. For trend following, the breakout, the pullback, right, where your stop loss, resistance, support is all the same. Right? The fundamental analysis is all the same. Macro analysis, all the same. Economic analysis across the board is all the same. You apply across all the it all comes down together. What time frame you want to use, what time frame you want to trade. Yeah. See, had you not wait for the part to complete, you would have bought this at a bad price, and now it's coming in. Now it's a red bar. It was nicely green, now it's turning into red. So that's why you have to wait. However, the histogram, I mean, okay, the moving average spiking up, the histogram is all up there. Look, you can see live histogram, the most recent bar, just turned from red to green again. If I go back, even compress down to a more detailed time frame on a 1 minute, here's the thing. If you use 5 minutes as your primary, you will switch back and forth and watch the 1 minute how it's moving. You can determine this is their momentum. You can determine the levels, right? But the 1 minute does not trigger the trade to enter or exit a trade. The 1 minute is kind of like additional information and give you a heads up But if you're 5 minute bar traders, do not use a 1 minute lower time frame to trigger the trade. You always stay with your original time frame to initiate the open or exit the trade. Otherwise, you're going to be you're trading 1 minute, you're not trading 5 minutes. I mean, like if I'm a daily bar trader and I start using 4 hours, well, then I'm a 4 hour trader. I'm not a daily bar. I understand this really clearly. I have to have this very clear in my mind. Because, I'm going to go inside the lower time frame and see what's going on. Next thing you know, you're trading on that time frame. Now you're no longer the higher time frame trader using, like, that position is based on the 1 minute bar, not the 5 minute. So yeah, so you can see this momentum on 5 minute, the histogram is in the red, and then but you pull back out to the 5 minute, it's still in the green, but you can see it's slowly dying. Slowly the momentum is wavering. It's getting compressed until at some point the 1 minute start ripping up, and then the 5 minute will follow, right? So, because the 1 minute will lead to 5 minutes. That's about, if I'm using the 5 minute graph, stay with the bar. Wait for the bar to complete before you enter the trade. Do not use the other time frame. Especially never use the lower time frame. Now what? You avoid getting chopped up and being all over the place. The whole point of why you want to use higher time frame is you want to take out the market noise. If you trade tick by tick, it's so much market noise, it drives you nuts. In that sense. Yeah. So Google, we're going to see likely maybe pull back. Right? So at the end of the day, is that I'm a daily bar trader. I still need to review what happened inside the day. Am I seeing an upside way up, or I see a huge spike and then a huge reversal and then a huge counter reversal again? Right? That if you're looking just at one single bar, you do not get that information. You still have to go back in the lower time frame to see the level, and you will start realizing, you're seeing, okay, people are coming in to buy at this point. People are selling here right now. You can see the peak, and they're selling. The question becomes, are they going to push it down to the breakout point? Where's the stop? People are getting off the boat, or they're selling. Are they actively selling? That you can tell from one bar long. You have to go down to lower time frames, like going to 4 hours to 1 hour, 30 minutes, 5 minutes. Right? And then you view this. Right? Although I'm waiting for daily bar for completions, and I'm waiting for formation of certain pattern, for certain situations, certain triggers, I still go back to the lower time frame. I like the hourly. Hourly is pretty clean. 4 hours is great, but 4 hours just too little information. I can see very clear. There's 2 days to break out. They attempted to break out at that time, but then it closed back down. Right now, it's attempting again. But now seems like it's still heavy because you don't have the market behind your back. You don't have the macro. You don't have all the other environment behind your back. So any breakout is going to be a little heavy. Right? It's not a good or bad thing. It's just the situation all add up and tells you, give you the signals what's going on. Yeah. So today, a breakout. Oh, Nvidia! Look at this. 1 hour tail, upside down false hammer. So that is a potential signifier end of this run. But this is hourly. Keep that in mind. Right, and that's a breakout. There's a breakout here. There's a gap here that created. So on the hourly, pull out to the 4 hours. You see this? So today for Nvidia, they are saying, okay, this is where some of the people are selling the holding, getting off the boat, taking profit or whatever. Right? That's what it's signifying. Tomorrow could be a very different picture. Every day it change, every hour is change, every minute can change. Right? As news, fundamentals, and all that different factors continue to rolls out throughout the day. Yeah. So Sound effects, these pretty heavy. Tesla, nothing. Meta's trying to break, but couldn't. Right there at those points, but it couldn't. But the pattern is there, the formation is there, the fundamentals are there, right? But the bigger picture, the market is not there. The macro environment is not there. The economic environment is not there. So they tend to be heavy. They tend to make it very difficult to have huge spike and run. Right? When everything lines up, then they run. So probably there's no trade today, but as it developed, it's going to require more than just its own fundamentals to really take off. And that's how it is. That's the nature. All the factors are lined up. However, it is a breakout. Again, it's a breakout. Right? And the rule is, when tomorrow make a new high, then today's high, you enter the trade. However, the other factors is not aligned. So that neutralizes the trigger point right now. And you have to wait for a clean breakout, 1 or 3 to 5 bars, and then wait for the pullback and see where the bias comes in on the pullback. Once you see the bias comes back in, you initiate this trade. Mainly because the macro, the economic, the market is not behind your back. I have more factors that's positive instead of neutral or negative. Then I can take the breakout trade on the next bar, which is tomorrow. But if tomorrow some economic indicators, some local macro pictures turn really positive, then I will take the trade. So it can change. It can change so fast. You have to be light on your feet. You have to be flexible. You have to change with times. Right. That's the nature. Right now I have a picture, but that picture can change anytime. When situation dictates as it requires. Right now it's heavy, but we will see. This is still early in the trade. It's only 40 minutes, half an hour, 40 minutes, 28 minutes to be exact after market open. Let's see what it does in the afternoon. And if anything of substantial, I will continue to upload additional videos. I'm sorry I didn't switch to the chart. I was talking, and then I didn't switch to the chart, and then later on I switched to the chart, and then we get the visual presentation. But the principle remains the same. The idea remains the same. Right? And those are the play that most likely. The other one, Cisco was good until it did the fundamental grab down because of news of its earnings and stuff. It just got crushed. So that is no longer a bulk buy candidate or bull candidate. Intel, that's a long tail on the upside, so it's probably people are getting off the ball with a little selling pressure. So are these guys. TSM pretty depressed too, right? Below 200 days. Oh, okay, that's the 4 hours. I go back to the 4 hours below 200 day moving average. That's pretty bad. Yeah, right there is fighting at 200 day moving average. You need a clean break above to consider even a buying candidate. Everything starts with data. You have to start with data. Even if I trade intraday, even if you trade intraday, you still have to look at the data because that is where everybody's watching. Where the big boys, the institution, the fund managers, where they're looking at. These are the important level. IBM, staying buoyant above 200 days moving average. Right? But when you compare those to the market leader, they're clear over 200 day moving average. So why you want to buy IBM when these guys are much more stronger on relatively strained basis? You always buy the strong instead of the weak. Yeah. So when the market break up, who should you buy? Not the IBM. You should buy the NVIDIA. You should buy the guy who are far away, way above the 200 days moving average. That's just much more buyers telling you, much more people holding the stock on the long side. You don't want to, and anything under 200 days moving average, you should not touch it. You should not buy it. Unless you pay the Warren Buffett, say a very long-term trend following, very long-term, you buy the undervalue of a good value stock. It's like a good value stock, but it's way undervalued. That's why it's around 200 moving days. That's why it's fundamentally, there's something bad about it. That's why it's under, right? You have conflicting fundamentals. That's why it happened. Okay, in that sense. Yeah. Continuing the list, take a quick look. Yeah, well, this is, you have this trend, but it came over last drop. So yeah, again, the big players for the foreseeable futures, at least these couple of years, are AI related stock, AI based stock. These are the guys, the market leader for this year, right? Nice percentage, very high percentage of this year's market gain is AI related and AI based. So this is the macro picture. Have to stay with that. Has to stay with what's hot. You play what's hot, not the what's cold. You know they're not going. Those stock won't go anywhere. Like marijuana, it's not going anywhere. Look at this. It goes up and it collapses back down. Yes, it tried to pull its ass up over 200 days moving average, and then so it comes in. Okay, it's time to get off. Time to get off, and then collapse back down. So this run is meaningless. If you're trend falling, you will get off the ball after it falls over the 200, falls back down, and that's a losing proposition to begin with. You stay with where the money's going, where the sectors are hot, and is AI. In these couple of years, all about AI. Yeah. Until the market tells you otherwise, and redirect you to the next sector where the money are flowing, active flowing in, money are active flowing out, one or the other, or even both ways, where you have a lot of volatility and there's a lot of opportunities. Why you want to play this guy? I won't. That's why I'm not watching it. Neo just crapped out. It's like crap or whatever. Alright. So yeah, waste of time again, and expand. Yeah. See, Lee, as I expect, if it's right backed up. And let it do a few days, and then probably just I've get secure puts on this, and we just take it off. I pocket whatever I make, or take whatever I made over the majority of the time premium that I gain on this, and that's it. And it's not going to roll to another trade next month, because look at this. The retracement is 50% already. If something that retraced 50% invalidated this whole half of the trend, I'm not going to open a decision to trade on this. Although it's still above 200 days moving average, but the time is not there. I want to see money flowing in. I want to see a trending situation. Then I play the stock. If it's not, there's no point. I'm wasting time. I should focus on something that's moving, that's going the way I expected it to. Don't waste your time and energy on things that's going nowhere. Right. Expand, yes, it's staying buoyant, it's staying nice, but right now, the whole sector is still kind of like the dogs, right? And no. So after this month, all the cash secure puts option that I have it, I'm not gonna roll to next month. Basically, it's telling me that, right? Until it becomes the hot sector again, then I start playing. So yeah, so that's about okay. So the AI direct like stock, like these couple indexes. Look at the indexes collapse back down, right? Look at the indexes. So the other stock, the much smaller stock, people are just rolling you out on the 200-day moving edge. Even if this is like pure AI play. These are very AI dependent stock, right? This is why I have a whole separate categories to house these guys, because they are not the market leader. They are not the mover. They are moving on back of the Magnificent Seven. This is why I focus on those. Focus on Google, Apple, and Meta, because they are the market leader. Right? These is piggyback riding on these guys. And majority of them is that this one team is above 200 days moving average. Majority of them just collapse back down. Yes, you have a nice one and it just collapsed. You can't even make through the first 2 months, and then people just sell right into it, right? Um, AI, right? Look at that. It is running, it is running. It just call it back down now below 200-day moving average. So that's not in play for me. That's not the one that I'm going to place my positions on. The ones in play still are the big guys, are the one that can not only affect AI, they can dictate, right, the direction of the AI world. So those are the guys that people are playing, and where money are flowing into and still flowing into. Of course, this can change because if they start taking off, eventually the little guys, the followers, will start having money injecting into it. They start taking off too, so they start forming trend. Hey, then I start playing them. But until then, otherwise, I would stay with the one that have the best prospect, most likelihood of a continuation of the trend. The trend already established. I just sideways, trace one, chop, 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 sideways, whatever. Right? I'm waiting for the next big wave, basically. Right? That's the dream of trend following. You're just adding to a winning position. Right? While option trader is selling option, it's the other way around. So it's, yes, you're very high probability of winning, but when you lose so much and you pick up nickel and dimes. Right? That teach you how to play the market, teach you how to read the market. Right? Those are practices. But when the time comes, this is where to make money. This is where, yeah, you make the bucket go, make or break, one or the other. You know, that's how. But we really think about it. Trend following is where you get your multiply. You turn your $1 into $100. You turn your $1 into $50. You're looking for 10 times, 20 times, 50 times, 100 times return on your capital. That's trend following. That's why they're so famous. Every successful trader, every successful hedge fund, every successful mutual fund is trend following. Any other thing, you play in reversal, you play your volatility, any other thing, it's just playing the market. That would not make you rich. That would not make you, okay? But these situations happen once a decade, 2 decades, right? Last time was the internet bubble, 25 years ago already. Right now, we might see the boom in AI. When that comes, we're going to see a huge, because this just will disrupt the whole market, disrupt the world, disrupt everything with AI. Right? AI, robotic, okay, these are the two biggest things. And then biotech. And biotech is very scientific, it's a whole different game. Okay? Unless you have the technical background, I don't suggest you play it. Those are hugely speculative. Anything biotech, even back in the internet days. So yeah, 25 years in the making. And that's how many 25 years you have? Well, you don't have that much 25 years, right? Yeah. Anyhow, so that's that for today. Very interesting. Everything is waiting to develop, but it's getting to the trigger point, getting very close to the trigger point. So everything getting set up, and I'm just placing all the pieces in front of it, and then when it takes place, then we'll initiate a series of trade, right? And we'll see where it goes. And maybe all this is the thing about trend following. You're going to take a lot of small losses because a lot of big breakout in situations like that until you latch onto a main trend, and then you just keep adding to every position. Just like beginning of the year, had I play Apple, I will have 50 times return. Oh, not 50 times return. 50 basis point return on each single unit. Right? $1 every dollar that was put in on 50 basis point Apple from 150 to 50, so 25%. Right? And that's just a mini trend in between that play. Yeah. But every position was a 50 basis point move gained. And that was just 3 times level up. Have I leveled up every step of the way? That could be an 80 basis point or higher. Huge return on these guys, right? Huge return. Yeah. And that's how hedge fund work. Yes, they will hedge the position certain way. The hedging comes in later when they want to hedge a profitable position, and they see a turning up. That's when you will use things like MACD divergence. Then you could place the hedge on the peak, and then benefit as it comes back down, and then you close out those hedge too. So you place both sides of the market, where you get additional bonus return. So instead of 50 basis point, you get a 10, 20 point. That then instead of 50 basis point, you get like 60, 70 basis point in that. That's when the reversal signals become important. That's when all the other pieces come into play too. And that's the next level. Level 3, right, is when you add the reversal and additional bonus and booster to your overall main trend. And to pay that, of course, that you might, if your timing is wrong, you might have to give a little bit of your profit too. So that goes both ways, right? Risk and reward, right? So level 3 is adding that to it, and then you have a complete gameplay across all different type of market, all different situation. Wow, within like 3 months, everything just come into play. Right? That is for a short period of time, and that's how it would be. And then you wait for the bigger trend to happen. Matter of fact, with the daily, if I start initiating all these positions, start loading up, right, if I pull out to the weekly, it give you so much conviction to actually stay with the trend. Right? Well, forget about it. This is the wrong picture. Let's go back to Apple. The example was Apple, right? The weekly, wow. You capture all this, and then on the level 3, capture retracement. You capture possible retracement. And then now you wave to go back into position. Go back in. Now here's the thing. It might do a 3 wave, right? It still haven't break this downtrend yet on the weekly. So you have to keep that in mind. You have to pull out. But if we go back to the daily, for Apple. But if you go to Google, right, so Apple is not. Okay, here's the thing. Apple, right? I'm saying if I have at a level 3 trade, play the retracement when that's this divergence. So this is where the opening of the position. Retrace, come back, right? Opening of position, retrace, because it's below right here. I'm just giving you a heads up on what are the level 3 trade on the retracement. How you play the trade is that you sold here, and eventually around here, yes. Right? So you pick up this half of this move. You won't pick up the whole thing on retracement. You have to be very light on your feet and just like, okay, right, that's just give me another what? Let's say 187. 2.7. So it give you another 10 basis point. As I say, it give you another 10, 20 basis point. This give you another 10 basis point. On top of that move, this is a 50 basis points you add every level of the way. Right. Pick the counter trend, and then you gotta get out quick on your feet. Right. As this, look at this. Divergent signal. Lower low, higher high. Which means the downplay, the retracement is over. This is an additional reason why I'm looking for breakup and a bullish play now. Apple already give me a divergent signal on the MACD. And Google didn't really have that in that sense yet. But Apple gave me a very clear indication. Matter staying buoyant up is breaking up, so that won't give me that divergent signal. This won't give me, but Apple have a very clear divergent signal that is going back into the bull mode. Okay, on this, very important. Yeah. While the other one is only inside the bull section of the play. Yeah. Okay, that's about it for this morning. I'm extending it a bit too much, already going to a level 3 setup on how to do the retracement additional booster. That has to be should be wait for later. But it's just a heads up that just run on in my mind. That's about it for today. We will see how that goes. I will review again tomorrow or tonight or later on throughout the day actually how Google will continue to develop how we trade. It did a breakout. Is it going to be clean? Right, going inside a lower time frame, right, into the 5 minute, 15 minutes, 30 minutes, and to see it's still pulling up the 5 minute. The momentum is there. Now it's making a break again. Upside way up. It just broke another level. So if so intraday trader having a ball. Today is a party day for Google. When it broke sideways, it broke up again. Oh my god. Eventually, yeah. The only worry is when will it do a reversal and how deep it is. Right now it's partying. There's partying going on in Google itself. And if the market picks up, the market is so flat. Oh my god. Look at that. All right. So it's all on the stock individual fundamentals of the stock itself. Yeah. So if the market picks up, this guys will just run to the moon. The intraday will have a great day. And these doesn't happen on intraday in actuality. Right? But when it happens, if the market behind your back, that's why they can make us some very good money. Yeah. Yeah. Anyway, so that's it for the day. I will have to stay with this and see how it develops for the day. It could be very interesting to watch Google for the day in actuality. See what it does in the afternoon and the end of the day. There's 2 more sessions, right? The morning section, the afternoon session, end of day session. And that will give me a very clear picture of what have taken place throughout the day and the levels that the speculator looking at, the players looking at. Okay, that's it for this morning. And then again, prosperity happens never by accident. Those plans accumulate over time. Thanks for watching. See you next one.